Welcome to the Explainer. Today, we are diving into something that sends the crypto world into a total frenzy, the Bitcoin halving.
I mean, you've probably seen the headlines, right? The crazy predictions, those wild price charts. But what is really going on here? Why does this one single, pre-programmed event get so much attention from pretty much everyone?
Okay, so this is where it gets really interesting. Let's look at the history. Now, quick disclaimer, past performance is never a guarantee of future results, but just look at this. Historically, the halving has been followed by some pretty huge price surges. After 2012, the price jumped from like $12 to over $266. And then in 2020, it went from around $8,700 to an absolutely mind-blowing $69,000. So yeah, you can see why this gets people talking.
So to really get why that chart looks the way it does, we have to understand what the halving is. This isn't just some random market thing, you know? It's literally built into the DNA of Bitcoin. Okay, let's break it down.
At its core, the halving is a key part of Bitcoin's design. The anonymous creator, Satoshi Nakamoto, built it right into the code. The whole idea was to control how many new coins get made, kind of like how mining for a real precious metal gets harder and harder over time. It's basically Bitcoin's built-in monetary policy.
And this timeline shows you exactly how it works. Right back at the start, miners would get 50 Bitcoin for every block they added. Then, boom, 2012, it gets cut to 25. Then 2016, it's down to 12.5. And after the 2024 halving, it's just 3.125. You see the pattern? Every single time, the reward gets sliced in half. This means new Bitcoin enters the world slower and slower, making the whole thing more scarce.
Which, of course, brings us to the big question. Why? Why would you build this scarcity right into the system? Well, it's all about the economic philosophy behind it, this idea of creating something totally different from the money we're used to.
And here's the absolute key. Unlike the money in our bank accounts, there's a hard cap on Bitcoin. There will only ever be 21 million of them. That's it. That number's locked into the code, it can't be changed, and that's what guarantees it'll always be scarce.
Now, think about how different that is from, say, the US dollar. Central banks can just print more whenever they want. And when that happens, you get inflation, right? The money in your wallet starts buying less and less. Bitcoin was designed to be the exact opposite of that. Predictable, totally transparent, and with that hard cap to fight against that very risk.
And that's precisely why you hear people call Bitcoin digital gold. Investors look at it and see something rare, something that can't just be created out of thin air. They see it as a potential shield against inflation. That built-in scarcity, that's the main attraction.
But it's not all celebration and potential price spikes. There's another side to this coin. For one really important group, the miners who actually keep the whole network running, the halving is a huge economic challenge.
I mean, just put yourself in a miner's shoes for a second. Your main paycheck, the block reward, literally gets cut in half overnight. But your bills, the massive electricity bill, the super expensive hardware, none of that changes. All of a sudden, making a profit gets really, really tough.
And the math can get pretty brutal. Just to give you an idea, there was a point where the cost to mine one single Bitcoin was creeping up towards $100,000. But the price of Bitcoin itself, it was only about $87,000. You don't have to be an economist to see that's a recipe for losing a ton of money fast.
So when things get that tough, it can lead to something called miner capitulation. It's basically a fancy term for miners giving up. They're forced to just switch off their machines to stop losing money. And if too many miners do that, the network's overall computing power goes down, which starts to raise some serious questions about how secure the network is.
Okay, so this all leads to a really fascinating long-term question about whether Bitcoin can survive in the end. Because these halvings, they're basically a countdown to a completely new phase. So let's jump forward and think about what happens when that very last coin is mined.
So these halvings are going to keep happening, roughly every 4 years, all the way until about the year 2140. And at that point, that's it. The last Bitcoin will be mined. The block reward will officially hit zero. From that day forward, the only way miners get paid is through the little fees we all pay to send transactions.
And that right there is the big, maybe even trillion-dollar question for Bitcoin's future. Are those little transaction fees going to be enough to pay miners to keep a massive global network secure? I mean, the entire security model, the whole thing, really hangs on the answer to that question.
Because if the answer is no, if those fees aren't enough, well, some experts warn that Bitcoin's usefulness
could just fade away. It could become like a museum piece, a really valuable digital artifact, but not something you can actually use. It's a pretty stark thought, isn't it? The same event that creates so much excitement today is also a ticking clock, counting down to the ultimate test of Bitcoin's entire grand experiment.